In our last video, we saw how earnings management can make companies look better than they really are. Sometimes these creative accounting choices cross the line into errors and fraud, and the company must restate or revise its financial statements. In this video, we'll look at what companies must do to correct errors, the FASB ASC 250 that governs error corrections, and why the concept of materiality determines what approach to use. Accounting Standards Codification Topic 250 for accounting changes and error corrections is the FASB standard that guides how companies correct errors and disclose restatements. When financial statements are revised, it's typically because errors in previously issued financial statements, including 1, accounting errors, 2, non-compliance with GAAP, and 3, fraud and misrepresentation. Accountants complete a materiality test to determine if the amount is material enough to require restatement or revision. There is no one-size-fits-all rule of thumb that can be applied to evaluate materiality, and the SEC defines materiality in the SEC Accounting Bulletin number 99 as information a reasonable person would consider important in making an investment decision. In fact, is material if there is a substantial likelihood it would have significantly altered the total mix of information available. The SEC emphasizes that this requires a holistic assessment of both quantitative and qualitative factors. So what does that mean? A quantitative factor might be the amount of the error relative to net income, or other key metrics, perhaps a percentage of 5%. Qualitative factors might be that the error amount changes a trend, changes a loss to net income, or changes key performance metrics. In other words, to be considered material, the amount in question would lead those receiving the financial statements to come to an inaccurate conclusion about the reliability and usefulness of the originally issued financial statements. Accounting rules require restatements or revisions only for items that are material. So this is a really important analytical step. If the error is immaterial, adjustments can be recorded in the current period. There are two types of corrections for material errors. For a mistake that is material for a prior period, the company informs stakeholders, reissues the prior financial statements, and revises the audit opinion. That process is called the Big R approach. Basically, investors are told don't rely on our past financial statements. That is a pretty big deal. The SEC requires companies to disclose within 4 business days that past financial statements should no longer be relied upon. And the 8K form is designed to be an early warning system so that the public knows immediately about the financial statement restatements and does not have to wait until the financial statements are filed with the SEC. Now, if the error is only material to the current reporting period, the company restates the current financial statements, also called little r or revision statement, for the error. That is a much quieter process and somewhat under the radar for many investors unless you study the company's financial statements and statement notes in detail. That is why they're sometimes referred to as stealth restatements. They're only disclosed in periodic reports and not in the 8K or amended periodic reports such as 10K or 10Q. So how common are big R versus little r restatements or revisions? Our textbook stated that the SEC reported a total number of 484 restatements in 2019, the lowest in 19 years analyzed. However, the percentage of revision restatements is high, 79% of the total. That compares to 479 restatements in 2024, with 68% of these restatements being revisions. What about immaterial issues, meaning the error is neither material to a prior period nor a current period? Immaterial corrections are reported in the current period as out-of-period adjustments. This table shows the leading causes of restatements over the past 3 years and gives you a taste of the actual SEC language behind them. Each quote is pulled straight from an Item 402 Non-Reliance 8K or the corresponding 10Q. You'll notice that the top restatement categories are revenue timing, income tax, and inventory. Likely because these areas are very technical and involve a lot of judgment, which can result in mistakes or aggressive assumptions. And these type of issues consequently can lead to restatements. Let's look at a few of these restatements. Evolve Technologies, a security technology company, restated its financial statement due to errors that resulted in premature or incorrect recognition of approximately $3.1 million of revenue for the years 2022 to 2024. SunPower said in its restatement that the value of consignment inventory had been overstated, resulting in the cost of goods for microinverter components to be overstated by approximately $16 to $20 million. And Equity Lifestyle Properties indicated that it had misclassified cash flows from the purchase of manufactured home as investing activities rather than operating activities. To recap, if an accounting error occurs, we look to ASC Topic 250 to provide guidance. We need to evaluate whether the error is material, and SEC Accounting Bulletin 99 tells us the concept of the reasonable investor and to use quantitative and qualitative information. In short, don't just use a percentage like 5% of sales. If the error is material to the previously issued financial statements, then those errors need to be corrected via a reissuance, and there are strict SEC notification timelines. The correction would include reissuing previously issued financial statements. Investors are told not to rely on prior financial statements, and the audit opinion is revised. If the error is not material to previously issued financial statements, but correcting the error or leaving the error uncorrected would be material to the current period financial statements. A company must still correct the error, but may do so in the current period comparative financial statements by restating the prior period information and disclosing the error. That is the revision statement, restatement, or little r correction. Now, if the restatement is not material at all, neither to the prior nor to the current period, the company can record the correction in the current year as an out-of-period adjustment. This type of restatement would require no revision or reissuance of prior financial statements. I hope you enjoyed this presentation and learning about restatements, revisions, and out-of-period adjustments.